Policy uncertainty, I think, is still very high, and that's why you get these tremendous relief rallies like you saw on Friday, where you feel like, oh, we've hit a policy jackpot. All the issues are resolved, and then I think you come back to just business as usual, where, in fact, all of these issues, whether they're trade or geopolitical or Turkey, still are there. But I think that there are some good pieces of information to get out of the market from today's action. You've got a lower VIX. That's a positive grind. And you've got a market that I think is pretty resilient. We've been calling it the Rocky Balboa market, because the fundamentals aren't great, but it can take a pretty good bit of licking and still get back up and not go down very much. And I think that's partly because financial conditions are just so easy that folks still find there's not really any alternative to stocks.
It would be amazing to hear right now, if I can change and you can change, we all can change. Dan, when you're looking at what this does, when he says he will decimate Turkey's economy if there isn't some pullback on the part of Erdogan, how do you read this into the risk to our markets?
Yeah, I mean, listen, it's not great. I mean, and I think the last guest just meant policy uncertainty is something that we're likely actually to see amp up. And, I think this president has shown us when his back is up against the wall, he acts the most erratically. This last act literally pushed our former allies into the arms of the Syrians, and it benefited the Russians and the Iranians, two other adversaries of ours, and Turkey is a NATO ally of ours, and we may have a war there, and it just none of it makes any sense. I can't tell you that it means a whole heck of a lot for the S&P 500 and for stocks, but it doesn't help the whole prospect of global growth that's already sort of teetering right now.
Let's move on to earnings season, which of course kicks off this week, and the overall sentiment from the analyst community has been fairly bearish. Bespoke Investment Group out with a new report finding that ahead of upcoming quarterly results, analysts have been cutting estimates for companies twice as often as they're raising estimates, but there hasn't been an uptick in the pace of earnings warnings from companies themselves. Paul, of course, behind this note. Paul, gauge for us exactly where we are on the expectation for this quarter and where you stand of what the market reaction is likely to be.
So the expectations are very low coming into this earnings season. They've been very low for the past 4 quarters. Historically, when you see very low expectations like now, the S&P and the market has done well during earnings season. So that's a positive takeaway. The last 2 earnings seasons, we had similarly weak sentiment. And what happened was earnings season was going great in the first month, and then it got killed with the tariff tweet. Happened both in the beginning of May and in the end of July. So that's something to keep in mind here. We had some sort of agreement or maybe a break in the trade conflict Friday. We're going to spend a few weeks putting, thoughts to paper and hopefully coming up to something that they can sign down the road. But I think in the early stages of earnings season, with expectations so low, when you have this low bar, it makes it easy to beat, and the stocks typically react positively to those beats.
Paul, where's the disconnect between the revised guidance from the analysts and the revised guidance from the companies?
Yeah, so it's very interesting. With the big pace of negative revisions that we've seen in analyst forecasts, you'd expect to see warnings at a very high pace. But for this time of year, they're actually right in line with the historical average. So we haven't seen, like you said, Contessa, there is a disconnect there. And I think a lot of it is, as Michael mentioned earlier, uncertainty is so high. The trade situation, there's a lot of uncertainty with respect to that as well. So it just creates an environment where analysts are cutting forecasts on the companies they cover because of this uncertainty. And one sector that's been particularly hit hard is energy. Energy revisions have just been the weakest of any sector, and that's partially because oil prices are at such a low level. So that's brought things in there as well. But and materials as well, with the strong dollar, you've seen materials estimates come in. But we haven't seen the big uptick in earnings warnings that you would expect, given such a dour tone on the part of analysts.